Okay, so exercise 18-4 is the first one. So this Jupiter company sell goods to Donan Incorporated. Okay, so we have January 2nd transaction, and then we have January 28th transaction. Okay, so part A says prepare journal entry to record the sale and related costs, right, on these two dates. And it's we assume that Jupiter records net method. So net method is basically you take you assume the discount has been taken or is normally taken, so you are taking a discounted price. So the journal entry will be, of course, sales revenue will be credit for $600,000. So 600,000 credit, and your accounts receivable is debit for $600,000. Right, so that's for the sales. Then we know, and you may have forgotten this, that every time we do a sales entry, we always have to do the related cost of goods sold entry, and that's makes up of inventory account, inventory, and cost of goods sold. Right, so I should have first written cost of goods sold. So cost cost of goods sold, and then the inventory. Okay, that will be credited, right? For how much? $500,000, and cost of goods sold is 500,000. 500,000. Okay, so cost of goods sold and sales revenue, these two accounts are income statement accounts, while accounts receivable and inventory are the balance sheet accounts, right? So we have to do this entry every time we sell. The net method is telling us to use 600,000 instead of 610,000, because we know that in this question they tell you that if the buying company, which is Donan, pays within 5 days, there's a cash discount of 10. So we already incorporate that 10 here because past history tells us so. So 600, so it's a net method. Okay, so this is the first entry, the January 22nd. Is, I'm gonna write it down here, January 28th is on 2028. Now you're gonna get the cash, right? So cash is equal to debit for how much is going to be, the company does not pay within 5 days, so it has to pay the full amount on January 28th, right? And because the terms are 30, so you have to pay within 30 days, and this company does that. But now it's going to be full amount. So the full amount is cash 610,000, right? So that is the first one. The second thing is that we are taking care of accounts receivable. This is the accounts receivable, but accounts receivable is worth $600,000, right? We booked it right here. Right here, it is, sorry, right here, $600,000. So we're gonna credit that because now we received the payment, and then the issue is how are we gonna explain this $10,000 in this extra in this sales extra cash that we received. We're gonna call it the entry. We can explain that it's called sales discount forfeited. Forfeited means something, not taken. Forfeited. Okay, so sorry about that, my mistake. That's credit $10,000. So this is almost like it's like extra money you received, and they never, the company, your buyer, your customer never made use of that, which is normally taken, right? So this is net method assumes that customer normally takes that discount, but